Welcome everyone to FX Street. It is Tuesday, January 25th, 2011. My name is Adam Rosen. It's 8:30 a.m. Eastern. Welcome everyone to FX Street. We have a very fun topic as always to talk about today. We're going to talk about oscillators. We're going to speak about the most commonly used technical indicators, the oscillators, the most commonly used oscillators to try to find trades in range-bound and trending markets. Lately, we've seen a lot of range-bound markets, so I think this discussion today is very apropos. Really briefly, before we get started, I just want to take a few seconds to take a look at the top stories of the news today, because there have been some big pieces of news and some a little bit of surprise to the market. All these pieces of news were reported on Bloomberg.com a little bit earlier. Australian consumer prices are talking about CPI advanced last quarter at the slowest pace in almost 2 years. The consumer price index rose 0.4% from July through September period, when it increased 0.7%, the Bureau of Statistics in Sydney said today. That was less than the 0.7% median estimate in a Bloomberg News survey. Now, the first sentence again, this is a theme that we see over and over again that I want to talk about a little bit. They say consumer price index advanced last quarter at the slowest pace in almost 2 years as a stronger currency lowered costs for household appliances, clothing, and cars from abroad. We see when the currency appreciates, goes to the upside because the economy is chugging along at a good clip. All of a sudden, that strong currency becomes a detriment to that economy. We saw the same thing with Canada last week. Last week? Yeah. This is in more news. The Bank of Japan raises growth forecasts for the year through March and predicted faster inflation as strength in overseas demand bolstered exports and pushes up commodity prices. After the board raises growth forecast to 3.3% from 2.1%, that by Governor Shirokara, and they also, by the way, left interest rates unchanged as expected at the 0 to 0.1% range. That's the Bank of Japan. In more news earlier today, and this was a real shock, Britain's economy unexpectedly shrank the most in more than a year in the fourth quarter as construction slumped in the coldest December in the century, hampered services and retailing. Gross domestic product, GDP, fell 0.5%, after increasing 0.7% in the previous quarter. The Office for National Statistics said today in London, they said growth would have been flattish without the impact of the weather. And in even more news today, and this was also a surprise, at least to me, Canada's inflation rate accelerated less than economists forecast in December as gains in gasoline, electricity, and automobile insurance were tempered by a decline in clothing costs. Again, CPI rose 2.4% in December after a 2% gain in November. That's what Statistics Canada said today. The core rate, which excludes 8 volatile items such as gasoline, basically food and fuel, quickened to 1.5% from 1.4%, but the expectation was 1.6%. So Canada's CPI, and here's, by the way, the FX Street economic calendar. Canada's CPI increased but missed expectations, so lackluster news. But look at the UK GDP, actually a negative, missing the previous previous month, I should say, missing the consensus or estimates, actually disappointing everything. Consumer price index in Canada, 0.1%. This actually shows a little bit, a little bit of a decline. We see year over year an increase, but missing the expectations. 9 a.m. Eastern, by the way, we have S&P Case-Shiller Home Price Index. Okay. I don't want to beleaguer this too much because we have a lot of stuff to talk about today. But what I mentioned earlier, and we're going to get to the charts now. What I mentioned earlier is that we continue to see over and over again the theme in the foreign exchange market, and this relates directly to what we're going to talk about today in terms of the turns in the foreign exchange markets, specifically driven by news. Okay. We had, for example, the Australian news this morning, but last week we had the Bank of Canada that kept rates unchanged at 1%. What did the Bank of Canada say? I actually was curious yesterday on my own. I looked at the Bank of Canada statements, their interest rate statements, and one interesting snippet what they had said was that, okay, things were going along pretty well in Canada's economy, but what happened was as the numbers continued to look better and better, especially compared to the weak numbers in the U.S., Canada's currency started to appreciate. And after a while, Canada's currency, the loonie, the CAD, went up so much that all of a sudden that started to hurt business in Canada, and that actually started to act as a detriment. See, the foreign exchange market always acts as a little bit of it has a rubber band or an elastic effect, meaning that the numbers are good in Canada, business improves, well, their anticipation, the Bank of Canada may raise interest rates, increases, we tend to buy, we as traders and participants in the foreign exchange market, we will then buy the CAD goes up, but after the CAD goes up almost, relatively speaking, too much, then the CAD becomes overvalued, a very strong Canadian currency hampers growth in Canada, and things start to slow down, and then the expectation will see our interest rate hike in Canada decreases, and then things come back to normal. And the same holds true to the downside. Things got so oversold and so unbelievably parabolically negative in Europe that eventually saw the euro dollar break down to the 128, 129 level, and the market said, okay, enough is enough. Things are bad, but they're not that bad. We need to see a little bit of a retracement back towards the center. Getting to our topic of the day, we're going to talk about convergence and divergence, which technically speaking, and by the way, just go to oscillators. We're going to talk about all oscillators today. Select the MACD, moving average convergence divergence. That's the first one we're going to talk about. As the foreign exchange market continues to behave in this very elastic way, good news sends the currency up, a strong currency becomes relatively overbought, and that in turn will slow the economy down, and then the currency will come back down, and then other currencies go down, will also bounce back to the upside. Those turns we can identify, I think, very, very clearly with the oscillators looking for divergence. Now, by the way, the parameters for the MACD are as follows: 12, 26 exponential moving averages over 9 periods. That's the simple moving average. These are the standard settings. So whatever settings, whatever chart package you use, plug in the standard settings. Now, I like to use the histogram bars. Imagine what we're looking at though. What I'm going to do is I'm going to plug in a 12 exponential moving average, exponential, and we're going to plug in another moving average. It's going to be a 26 exponential moving average. We'll change the color here just so things are very, very clear. And we can see as the market's trending to the upside, the 12 exponential moving average, which is the shorter term, moves above the longer term or shorter or longer moving average or the slower moving average, the 26 exponential moving average. Eventually, and this is a behavior with all moving averages, why do we use a 12 and 26 EMA exponential moving average in the MACD? I don't know. Whoever had put the MACD together originally had found that these settings tend to work the best. Some experiment. I leave the settings where they are. I like to see the trade signals that everyone else sees. Notice, and what's important, is that when the market turns from an uptrend to a downtrend, the 12 exponential moving average, the pink line, crosses back below the blue line, the 26 exponential moving average, roughly at this point. Notice during the same period of time, the MACD histogram bars move from a positive to a negative. Positive to a negative actually shows us the moving average crossover, but that's not what we want to look for. What we want to look for is convergence or divergence. Divergence is disagreement. That means when the market makes a new high, yet the MACD or the oscillator at hand does not make a new high. Notice what we're talking about here. Notice the market hits a very significant high, 141.59 on October 15th. By the way, this is a euro-dollar daily chart. Note the position of the MACD histogram bars. We could even move back to the highest high in the histogram bars, and that shows us divergence on its own. However, moving forward, notice the market made a new high. Notice, comparatively speaking, where the MACD histogram bars. Market makes a high, histogram bars are very high. Market makes a higher high, but the histogram bars make a lower high. Higher high, lower high, this disagreement, is also known as divergence, and this is our excellent sell signal, telling us that, well, the 26 exponential moving average, a blue line, it seems to be getting closer and closer to the 12 moving average. Why? Because this trend is starting to slow down. Before an uptrend turns into a downtrend, the uptrend slows down. It slows down when the moving averages start to come close to one another. That's the first initial sign of a reversal. Remember, when the moving averages finally cross over, and most people consider it too late to sell short, after all, who wants to sell short at 135.74 when we could have sold short up at 142.81? But that actual crossover did not occur until the MACD went from positive to negative. In my opinion, I think that's too late. So we'll take this line away. What we want to do is look to sell shorts when the market shows us a higher high, and then we would look to a shorter term chart to look for the reversal pattern, and then we would look for the divergence. Higher high, lower high. That's divergence. Now, convergence is the opposite. Convergence occurs when the market makes a higher high and when the MACD also makes a higher high. Let's talk about convergence. Notice the market, the euro-dollar daily chart, 133.33 on August 6th makes a very significant high. Note the position of the MACD. Then the market breaks out to a new, even higher high, and notice the position of the MACD. We start to accomplish higher highs. Now, there is quite a bit of separation. On a daily chart, we're talking about the beginning of August through the end of September, so about 2 months of trading. That's why there's a little bit of a delay. Also, you're going to notice there is a little bit of a delay with the MACD. It's a slower moving indicator. If you're looking for an indicator that's faster moving, faster reacting, look to the RSI, which we'll talk about in a moment, and even faster than that, I think, would be the slow stochastics. Convergence also occurs when the market breaks down. Note the very significant low. The MACD accomplished over here. Not that significant, actually. And then the moment the market breaks to a new low, note the position of the MACD. Lower low, lower low. That's convergence or agreement. We would sell shorts. If we miss the sell signal, which really the sell signal occurs when we hit a higher high and the MACD makes a lower high. But the second chance we have is when the market actually breaks down, we see the convergence. The divergence, the turn happens before we turn back to the downside, and then we have the breakdown, which is the convergence. Look for the divergence first. Look for the disagreement first. Now, you can throw in another technical indicator, another oscillator. Oscillator is basically an indicator which shows up movement versus down movement. The next one we talk about is the RSI, the Relative Strength Index. That's that blue line at the bottom. Measures the relative strength of the market over a period of 14 periods on a scale of 0 to 100. Indications above 70 are considered very strong. Indications below 30 are considered very weak. And typically, the reversal signals we look for are when the RSI crosses above and back below 70 or below and back above 30. Let us look for the same convergence divergence though. Market euro-dollar makes a significant high, again going back to the beginning of August. The market breaks out to a new high. Notice the position not only of the RSI, but notice that we're above 70. When we're looking for a convergence to breakouts, a breakout where the market makes a new high and the RSI makes a new high, we're looking for the RSI not only to be a new high, but preferably above 70. When the RSI is above 70, it's at 76 at this point, or below 30, it shows us the market's moving very, very fast, because usually we don't see readings above 70 or below 30. And notice all the trading activity that takes place, the market does not go, the RSI does not go above 70 nor below 30, except for maybe just 1 or 2 times. So we're looking for the convergence breakout. We have to see a higher high on the market. We have to see a higher high on the RSI, and preferably the RSI should also be either above 70 or below 30. Notice now, at this point, the market makes a pretty significant high. RSI crosses above and back below 70, and that is our textbook sell signal right over here. When the RSI crosses back below 70, notice the divergence that occurs. The market makes a higher high, the RSI makes a lower high, and the RSI is also below 70. Logically, we could ask ourselves a question. Why is it that at this point, on October 15th, the RSI was above 70, and at this point, November 4th, I mean, that took about 2 weeks difference, The RSI is significantly lower. It's also below the 70 level, yet the market's making a higher high. Shows us from a different point of view, the market has already also ran out of steam, and it's pretty much near the end of its move. We also talk about oscillators like the indicator oscillators. Go to the slow stochastics. This, I think, is even a little bit faster. I mean, you'll get the trade signals a little bit more frequently than the RSI, which is probably gives you a more frequent signal than even the MACD. Slow stochastics, I like to use also the standard settings, 533, obviously. Similar to the RSI, but instead of using 30 and 70, slow stochastics will always use 20 and 80. And what we're looking for the reversal signal is when these two stochastic lines cross above or below one another, when they are both above 80 or when they're both below 20. We're looking for the crossover above 80 or below 20. Now, exercise a little bit of caution because these signals are going to occur much more frequently. So if you're using the slow stochastics, you're going to get, I would say, a higher frequency of false trading signals. I don't know necessarily if I would use slow stochastics with another oscillator. I don't know if I would use 2 or 3 different oscillators together. I don't think it would add a lot of value because essentially all technical indicators, especially the oscillators measure movement, up movement versus down movement all the time, up to down, and how fast the market was able to achieve those moves. Oscillators basically all measure price over time. So you're measuring the same thing at a little bit of a different speed, as opposed to something like a moving average, or even far different would be trend lines, Fibonacci, candlestick analysis. That measures the market from a different angle, a completely different point of view. But to look at the market in terms of the RSI, the MACD, and slow stochastics, you're just seeing an earlier or a slightly later version of the same move. So why do we have so many different technical indicators? Because very simply, us as human beings, some of us tend to work better with the MACD versus the RSI, the slow stochastics. Personally, I like the MACD the best because, maybe it's my own personality, but I find myself, I tend to jump into trades very, very quickly. At least I have in the past. And I like to use the MACD because it slows me down. I think that if you have the type of personality where you find yourself jumping into trades, too early and too frequently, try using the MACD. It'll tend to slow you down. If you find you just keep on missing the trades, maybe you're too patient, you're waiting too long looking for a signal, and you use the MACD, maybe use the RSI or the slow stochastics because those tend to generate trade signals more frequently, and it'll help to speed us up a little bit. I think that's probably one of the best ways to use these different oscillators. By the way, if there's any particular currency pair that you like to see, I like to cover quite a bit, but I certainly would like to address what we're looking at together and what all of you would like to see. Now, another note, a quick note about using these oscillators. When we're looking for divergence, or let me say from this point of view, Ray, do you want to see the euro? This is the euro dollar. Did you want to see a different euro cross other than the euro dollar? Because it's the euro dollar daily chart right here. When we're looking at a market that is range bound, expect divergence to occur, expect reversals to occur more frequently. When you're looking at a market that's very, very trendy, then expect convergence and breakouts to occur more frequently. We should try to, match our own trading style to the best currency pair and the most appropriate technical indicator. Meaning that if we tend to make the best trades, the best money when we pick tops and bottoms, that just simply intuitively seems to suit our personality better, and you want to look for tops and bottoms, you want to buy low and sell high using divergence, using, let's say, the MACD, for example, what we would do is look for a currency pair that is not very trendy, that is more likely to have shorter-term reversals. To construct that currency pair, we should consider the currencies that go into that pair. Look for two currencies moving in the same direction, such as the dollar and the yen lately, as opposed to currencies moving in the other opposite direction, such as the euro against the Aussie or the euro against the pound at this point. This is, by the way, the euro dollar. Please let me know if there's any other currency pairs you'd like to see as well. A different question: will these oscillators, convergence and divergence, work forever, or at least the same like time when they developed these techniques? Well, nothing is 100%, but as long as I've been looking at the charts, many years, I haven't found these oscillators to be any more or less reliable. I think they're, like anything, it's only as reliable as they are in the hands of the user. But I don't think, to answer your question, I don't think a day will come when these oscillators won't work. I mean, very simply, all it's doing is, breaking down, analyzing the data in terms of how much the market has been able to accomplish to go up or down over a certain period of time. And during a very trendy period, when the market goes up, well, the fast-moving average tends to pull away from the slow-moving average, and the MACD moves to the upside. And then eventually, when this uptrend starts to dissipate, and before we turn to a downtrend, as we just start to slow down a little bit, and the slow-moving average has a chance to catch up to the fast-moving average, well, eventually the MACD will start to make a turn. The RSI, conversely, will also start to make a turn. Slow stochastics already would have done so. Notice, by the way, the slow stochastic signal occurred far before the MACD signals occurred. That's what I mean. Slow stochastics is going to get you in trades faster and more frequently, and running the risk of false trades. Getting back to what I was saying, let's talk about a trendy currency pair. Now, we read some news today. UK GDP was less than expected. It's actually negative. Okay? And we didn't read today, but in general, European data has been quite good. I had some pretty good numbers last week and this week. So we talk about, let's talk about it as long as we're at it. We talk about a currency pair that is range-bound. The euro-pound, this is a triangle consolidation pattern. It's very range-bound over a long-term basis. This is a daily chart. Range-bound markets occur when two currencies in the pair go up together or two currencies go down together. Basically, when both currencies within the currency pair tend to be affected in the same way to the same news. Historically, what's good for Europe is good for the UK. What's bad for the Europe is bad for the UK, and also the Swiss franc as well. That's why the euro-pound is never really, on a long-term basis, it's not really trendy. I mean, going back to 2008, we haven't really moved anywhere. We're actually the same spot, more or less, that we were December of 2008 as we are right now. Of course, we've gone up a lot and down a lot in that period of time, but on a long-term basis, it's very range-bound. But as I like to say, within every range, there's a smaller trend, and within every trend, there's a smaller range. Take a look at this very long-term range, and then inside this range, we have on the smaller time frame, we have a huge trend that goes up, and a trend that goes down, and a trend that goes up, and a trend that goes down. And even if we were to zoom in on a daily chart, we can see immediately this is a trendy market condition. We went from the lows of 82.84 on January 10th to 86.28 currently, 86.38 earlier today. That is huge. That's a 500 pip move in the last 10 days or so on the euro pound, which is kind of unheard of. So over a short-term basis, this market is very, very trendy. Of course, we go to a 30-minute chart. We can see within this trend, there's also short-term ranges, but let's stay with the daily chart for a moment. And let's plug in our indicators, specifically the MACD, moving average convergence divergence. Now, let's go back to that long-term triangle consolidation pattern. Market hits a very significant high, going December 24th of 08, and then eventually moves to the downside. Notice the position of the MACD histogram bars when the market hits these significant highs. Market hits a significant low and then moves back to the upside. Market makes a lower high and MACD makes a lower high and reverses back to the downside. Now, let me show you two things. First of all, let's take away this. Okay. Notice what happens over here. This is interesting. Okay. This is convergence. The market, let's take away this line here. Okay. Market makes a significant low. This, by the way, is a low in the euro pound, February 10th of 09. MACD histogram bars make a pretty significant low. The market, the euro pound in this case, ends up breaking. We'll draw a horizontal line to mark up the low. Okay. Market breaks down to a new low. And what is a signal? The market's going to actually break down to a new low. The MACD also has to accomplish a lower low as well, which technically kind of looks like it did. Let's see here if we get a better signal. It's not a clear signal. But the MACD ends up showing a little bit of a lower low. Let's see, the lowest low over here is 0.01. This MACD is 0.007, almost identical lows. Not a really good example. Again, this is a euro-pound currency pair, so it sort of kind of proves my point, the fact that it's a range-bound currency pair by nature, so we're not going to see very significant lows or highs. Let's see if I can find a better example, though. MACD makes a significant low. MACD makes a lower low. Again, euro pound, so we don't see a lot of convergence. We don't see a lot of healthy breakouts. The MACD makes similar lows even as the market makes a lower low, and it shows us, well, the market really doesn't have the potential on a very long-term basis to break out one way or the other. We can now throw in our auto scroll over here. Okay. Now zooming in again on the daily chart, just keeping everything on the same scale. Here we go. This is what I'm looking for. This is convergence. The market makes a high, the MACD establishes a certain level. The market makes a higher high, and the MACD hits a higher high as well, or at least in this case, a higher low. In any case, the agreement that the market breaks out to new high and the MACD breaks out to new high, all the better. Now, notice these very significant highs in the euro pound, 85.9, 86.47 actually. Let's move this horizontal line, 86.47. Today's highs, 86.38. If we break out to new highs, we want to see the MACD also accomplish new highs. So far, it has not. And that shows us that, hey, we're in a range-bound market, and there's not a good chance that we're going to break out to new highs. Now, let's take a currency pair that has been a lot more trendy. Over the past couple of weeks and months, we've had some really, really good news come out of the Eurozone, some really bad news come out of Australia, including today. Was it CPI, I believe we read, right? Throw in the indicator like the MACD, moving average convergence divergence. Now, we draw a vertical line when the market makes a significant low. And what I found in general is you want to try to find these double bottoms and double tops as close as possible together. We don't want to see, we looked at the euro dollar in the past. We don't want to see, a good amount of time. It's kind of relative, on a daily chart. You don't want to see like 2 months go by between the double bottom patterns, because then it sort of distorts the effect of the MACD and the other oscillators as well. However, the 136.59 low was established in the Euro Aussie on November 11th of last year. MACD makes a particular low. MACD actually does not make a new low until we officially break down. Little bit of a delay. This is what we talk about when we talk about the delayed effect of the MACD. Notice the market made its new low actually as soon as November 24th. the MACD did not give us the actual sell signal until December 5th. Doesn't mean we missed the move. In fact, the move actually moved down quite a bit further, but this is a delayed effect of the MACD. If you want to look for something a little bit faster, look for the RSI, Relative Strength Index. Notice the RSI just at the 30 level crosses to a new low, and the MACD actually gives us a pretty similar signal over here as well. Maybe the slow stochastics will give us a little bit of a faster. Euro Aussie makes a significant low 129.23 on December 29th of last year. Then we hit a little bit of a higher low, 129.28. That's only 5 pips difference on January 10th. Notice the difference in the MACD. Notice the divergence or the difference in the RSI. We could even throw in the slow stochastics. What's just something else? You can look at it as well. Slow stochastics gave us a buy signal much earlier. You can see this is the buy signal where the mouse is, going back to December 22nd. That's when the two lines crossed over one another below the 20 level. I'm just going to take that away for a moment. Let's talk about another indicator as well. And if there's any currency pair that you'd like to see, please don't hesitate to chat it in, by the way. Another oscillator. That we talk about is the average true range. Works a little bit of a different fashion. It works on a scale of 14 periods, essentially measures the length of each candlestick, the average over 14 periods, from low to high. It actually measures more than that. That's a very simplistic version. If you want to look at the actual calculation, it's very easy. Just go to Google and type in the ATR, average true range, to look for the formula. It actually takes into consideration the open, the close, the low, and the high of every candlestick over the past 14 periods. But as trends start to get more complacent, and we start to get a little bit comfortable that, hey, the market goes down almost every single day, all I have to do is just sell short and I'm going to make money, you can see the ATR drops to the downside. Notice the ATR is not a directional indicator. The ATR does not move down because the market's moving down. Like the MACD or the RSI does. The ATR moves down because the candlesticks are getting smaller and smaller and smaller. Eventually, the ATR hits a very big bottom at spot 0087, which, by the way, stands for the amount of pips that we enjoy every day. 0.008 or 0.009 indicates around a 90 pip difference from low to high every day. When the candlesticks start to get bigger, we see the ATR moves back to the upside. The reason why the ATR is considered an oscillator is because reversals, major market reversals, sometimes occur, or oftentimes occur, when the ATR turns from the downside to the upside. ATRs hit significant lows when we get very, very comfortable in the market. When the market goes up, or down, down, and almost every single day, the ATRs, the candlesticks get smaller, the market gets very quiet, people get comfortable and complacent, and the ATR goes down. Eventually, the market reverses, and people get a little bit surprised, and so a lot of trades end up losing money. Margin calls, stop orders, the market reversals, the candlesticks get bigger. ATR works in a similar way to the VIX, the volatility index. When the market goes up in the stock market, and it's a little bit more directional in terms of the stock market, but actually not really. When the market goes in one direction for a certain amount of time, we start to get very comfortable doing the same thing. I remember the days trading stocks, that there were a period of times when the market got very, very trendy to the upside. And almost any strategy that you would pick, as long as you bought stocks, generally speaking, you would make money. You know, this was true in the late 1990s. This was true in 2006, 2007, before, obviously, the stock market crashed. It even has been the case recently. Stock market goes up almost every single day. And so anything that we buy, eventually, is going to go up. And that we're probably not going to get stopped out on too many trades as long as we use a good stop order and, you know, we don't buy too much position. But if we sell shorts, chances are we're going to lose money. Take a look at the Dow Jones Industrial Average. This is Dow Jones Industrial Average futures. Let's count back. And this is, kind of a choppy trend over here. But we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 red candlesticks. Let's see if I can count quickly here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 25. This would be 30, 35, 40, 40, 50, between 40 to 50. I'm approximating. Out of the past 40 to 50 candlesticks, 12 have been red and 30 to 40 have been green. That's a 3 to 1 or 4 to 1 green to red ratio. That means that, and by the way, take a look at the trend lines. If we buy a stock, and this is, indicative of the stock market because the Dow Jones Industrial Average, if we were to buy the Dow and place our protective stops below yesterday's low, such as here on December 8th or December 9th or 10th or the 15th, etc., generally speaking, we would not get stopped out. The market just continues to go up and up and up. Now, if you throw in the ATR, average true range, shows us we're getting very, very comfortable. Now, the ATR is trying to rise a little bit to the upside, but if you zoom out to put this in a little bit of perspective, look to see where we were on the ATR. Now, of course, those very, very big market days going back to May of last year were not the usual. But even more recently, the ATR has absolutely dove to the downside. We were an ATR of over 300 going back to May of last year. That means average of 300 points from low to high every day, every candlestick. The average over 14 periods. As we move forward, though, the ATR hit ultimate lows of 66. Right now, looking at an average of around 100, 199, 105, right around there. That means every single day on average, the Dow Jones Industrial Average only enjoys a range of low to high around 100 points. The indicator in the middle, by the way, is volume. We don't talk about volume in the foreign exchange market, but volume can also not considered to be so much an oscillator, but when we look for reversals, the market sometimes reverses right around the emergence of very, very big volume. This was that unusual day when we had that 1,000-point swing from low to high. So this doesn't represent the true volume spike. I would look, a little bit further to the second highest high, without the second highest high, May 21st of last year. Reversals oftentimes occur at the bottom of volumes and the bottom of ATRs. So we look for divergence and we plug in the MACD to see if we can talk about divergence as we know it. Zooming in. So far, we see the market's making new highs, and the MACD, at least over the short-term basis, is making new highs. So far, this is divergence. So far, the trend is your friend, and the MACD today reads the highest reading of the MACD going back quite a bit. And therefore, and you see this, when we talk about going back to the highs in November of last year, you say, hey, look at the MACD. It was higher back in October, November last year. Yeah, but that's going back, 2-3 months. Eventually, you cannot really compare these highs. We want to look for the immediate highs, double top highs. In this case, the market breaks out. And it does, in this case, show us convergence, agreements. The market's making higher highs. The MACD's making higher highs. And so far, and the ATR is actually turning back to the downside. The ATR, relatively speaking, is at a relatively low level, shows us the market's complacent. We're very comfortable, but for the time being, the market's continuing to go higher and higher and higher. You can look at the same things when we talk about, let's go to a weekly chart here. Take a look at the ATR. Take a look at the overall condition. I think this is so helpful in technical analysis. You take a look to see how the market behaved before the last big moves. Remember the stock market, this is a weekly chart, hit those highs 2007, October 2007. The Dow futures are up near 14,000. ATR, well, that started to increase, but take a look at the lows of the ATR. The lows of the ATR occurred, whoops, those ultimate lows occurred January 21st, 2007. We actually did not hit those highs until October. So the ATR gave us a signal quite early. I want to really zoom in and take a look at the highest high we saw going back to October of 07. See if we could have found the top if we were on the lookout for it. Well, the market makes a higher high, and the MACD makes a lower high. Take a look at the all-time high. 14,000, the MACD had already shown us a little bit of a reversal. ATR gives us a signal a little bit early and starts to rise to the upside, shows us, things are not so complacent, things are not so easy. The MACD gives us its ultimate sell signal almost exactly near the high, October of 07. The crossover MACD from a positive to a negative, which is definitely something we wouldn't miss if we were looking out for it, that occurred a little bit later on. Remember, the divergence signal you're usually going to get first. Divergence is when the market makes a higher high, the MACD makes a lower high. There we go. MACD makes a higher high. Market makes a higher high. The MACD makes a lower high. But eventually, there we go. The market breaks down to new lows, and the MACD turns negative. So the great sell signal, the divergence occurred October 7th of 07, approximately. The MACD turned negative December 30th. The actual breakdown did not occur until January 13th. Now, the low of January 13th was still up at 12,047, and we know where the market went since then. So it doesn't look like we missed too much. But all the same, the divergence gave us a signal a little bit earlier. We can look to the downside as well, by the way, and we take a look at the market ultimate bottom, and we can see how the MACD already had started to make higher lows during that period of time. Notice the market, the Dow Jones Industrial Average, makes that ultimate low of 74.33 on November 16th, and then makes a new lower low on a futures basis, 64.57 on March the 1st. That was in 2009, by the way. MACD already generating a higher low. And in fact, note what happened. The MACD turned positive. We missed the divergence. The MACD, the convergence, occurred July of 09. Even if we bought the high of July of 09, 90.52, well, we know that where the Dow Jones Industrial Average is now. We're at almost 12,000. Definitely a lot of space, a lot of time, a lot of opportunity to get into trades. Notice how the ATR and the volume make significant highs. December 7th of 08, first week of December, and then soon after we have the reversal when these big candlesticks start to get a little bit smaller and complacency returns to the markets. Again, to recap, we can use the divergence, or we can use these oscillators, I think, best used to look for convergence and divergence. Divergence is disagreement when all of a sudden the charts, the market in terms of on a price-to-price basis, does not agree with the indicator at hand, the oscillator at hand. The slower indicators include the MACD. A medium speed would be the RSI. A faster one would be the slow stochastics, I think, in my opinion. So if you find yourselves missing too many trades, look to use a faster indicator like the RSI or slow stochastics. If you find yourself in too many trades and really anticipating trades before they occur, try to use a MACD. That will slow us down and tend to keep us in longer-term trades. In terms of the Dow Jones Industrial Average, so far the volume decreases. We saw the ATR is decreasing. MACD continues to make higher highs. So for the time being, the trend is your friend. Stick with the trend. Eventually, we'll see a reversal using the oscillators, some of the ones that we spoke about, gives us the best chance of finding, the early spots at reversal and maximizing the reversal in the market. I hope this has been helpful. If you have any questions, by the way, you can contact me anytime, www.forexfinance.com. I want to thank you all very much for joining us. Very special thanks to FX Street. By the way, please see their calendar because later on this week, we have much, much more. I want to thank you very much for joining us. Wish you a great day. All profitable trades, and we look forward to seeing you back.